first and foremost, the US dollar continues to be the reserve currency of choice around the world. I don't see that changing anytime soon. The other thing I think about with particularly the preliminary use cases for the dollar and non-dollar.
We have excellent connections and partnerships with local payment fintechs, payment app, card programs, the local government as well. And they are seeing a very meaningful growth, both in supply and transfer volume, but especially in payment.
I have to go Korea as well. I mean, when I was doing the data pooling and seeing how how big the ramp in Korean exchanges has grown, it's quite remarkable because you're not seeing any type of on-chain stablecoin presence for the Korean won.
Good afternoon, everyone, and welcome. Thank you very much for joining us. I'm Ben Harvey. I'm a digital assets researcher at Keyrock, and I'm going to be the moderator for today's webinar. We're here to talk through a piece of research that Keyrock published with Bitso called How Local Stablecoins Trade from Exchange to On-Chain. Before we get into it, I'd just like to set some context and kind of set up the question that the report and then this webinar will be trying to answer. I think it'd be kind of very good to get that framing for the next hour or so. So until recently, stablecoin pretty much meant a dollar stablecoin. Through 2023, the euro, the Brazilian real, the Japanese yen, and a long tail of all these other currencies barely registered on-chain at all, and marginally on centralized exchanges. That's since changed quite a bit. Non-dollar stablecoin supply has grown 50-fold since 2020. We've also seen 19 local currencies now trading actively against stablecoins on centralized exchanges, which is up from just, I think it's 10 2 years ago. And the dollar's share of that trading, which historically is sat, around 50%, it's been below 50% for the last three consecutive quarters, which is the first time we've seen a sustained run below that number. So things are definitely starting to change in terms of the dollar and non-US dollar stablecoin landscape. What Amir, who joined us today, and I'll introduce shortly, and the contributors did in this report was track local stablecoins through 4 distinct stages. So you can think of it as the on-ramp, the exchange ramp, where local fiat meets a stablecoin, the cross peg, which is essentially stablecoin to stablecoin trading, usually on sexy on-chain, the bridge, which is where tokens leave the exchange and into someone's self-custody wallet, and then finally native on-chain trading and liquidity pools. What's really interesting is that the market tends to thin out dramatically as you go down each step. And I'm sure that we can get into that over the next hour or so. So the questions that we want to get into today are, why does that happen? Why is it thinning out? What unlocks the next currency flowing through that process? And where are we actually in terms of seeing this work already rather than just being built out? So I've got 3 people here that I think are perfectly positioned to answer those questions. First up, we have Jack McDonald, who's Senior Vice President of Stablecoins at Ripple. Jack, would you care to say a few words about yourself and also Ripple?
Sure. So first of all, thanks for the opportunity to be here. I love talking about stablecoins. Anytime I can find a group to do so. I joined a little over 2.5 years ago through an acquisition of New York limited purpose trust company Standard Custody, that's now the issuer of RLUSD, or dollar-backed stablecoin. Ripple, founded in 2012, initially as a cross-border payments company that has evolved into an institutional infrastructure company, providing a one-stop shop really across the board for institutions who want to access digital asset and digital rails. So whether it's the legacy payments business, a more recent corporate treasury management business, we've got custody, a couple different versions of that. We've got prime brokerage, we've got a stable coin, and we contribute meaningfully to a L1, the XRP ledger, which was built for payments. So it's a logical step for Ripple to have made, and really excited to be in the industry and to talk with you guys this morning.
Brilliant, thanks for that, and it's certainly a pleasure to have you here with us today, Jack. Next up, we have a returning guest in Filippo, who's been on one of these webinars before. Filippo, you're head of research over at Dune. Would you like to introduce yourself and Dune as well?
Yeah, thank you, Ben. Again, thank you for having me here today. As you mentioned, I'm leading research at Dune, and we just released, in February, we released a report on non-USD stablecoins together with Visa. And I think a lot of the numbers, a lot of the trends that you guys highlighted, we found as well. So I think a lot of the things match. You guys then went deeper into a lot of these dynamics. We just wanted to basically present a landscape, a picture of like the overall situation of non-dollar stablecoins, which is a topic that it's a lot ignored. Like it's not really hot or discussed, but we think deserves attention. And yeah, we together with the report we released a full data set. So it's a curated data set on stablecoins, including USD and non-USD stablecoins. We cover over 200 stablecoins, and you can track supply, transfer activity. We also have a very rich tagging system, so we are able to see not only how much of each stablecoin is out there, but also where it's sitting. And also the transfer activity, we are able to qualify the type of activity that is going on, if it's like a payment, Treasury, DeFi related transfer activity. So we are very excited to talk about stablecoins and go deeper on this vertical.
Yeah, very cool. I know that myself and Mia, we love using Dune data, so we're excited to dig into it in a bit. Finally, we've got the author of the report and my fellow researcher at Keyrock. Mia, do you want to say a few words as well?
Yeah, very excited to be here. Over the last few months, we worked on this research piece, and that's essentially the crux of the work that we do as researchers at Keyrock. We dive deep and provide analysis on these sort of subjects, and we also see whether there's new business or revenue streams that can come from it. I'm sure we'll touch on a lot of the new markets that have emerged, like when you look through the data set. So yeah, I'm very excited to be in this call and to have this discussion with you guys.
Okay, brilliant. Well, thank you all. Let's dig into the questions then. So I suppose, Jack, it'd be great if we could kick off with you. One question that I think would be good to just kick off the discussion with is that as local stablecoins grow, do you see them taking share from US dollar stablecoins? As a very broad first question.
Yeah, I really don't. And I think the overall stablecoin market will grow in a meaningful way going forward. And I think non-dollar stablecoins will grow as well, but I don't think they will grow at the expense of the US dollar. I think about that from a couple of different lenses. First and foremost, the US dollar continues to be the reserve currency of choice around the world. I don't see that changing anytime soon. The other thing I think about with particularly the preliminary use cases for the dollar and non-dollar stablecoins is that a lot of these local currency stablecoins need an off-ramp into USD. And so if you think about whether it's a euro or a Japanese stablecoin, oftentimes the sender or receiver ultimately wants to get a cash leg that is into a US dollar. And I think that's where the US dollar-backed stablecoins will grow in tandem with the growth that you mentioned. Still off a very low base for the non-dollar stablecoins. I am bullish on that side of the market, but as I said, I think the US-backed stablecoins will grow in tandem with that and continue to be preferred.
Yeah. And do you think that's the nature of kind of the liquidity on US dollar stablecoins on chain as well, in the sense that you kind of have to route through those kind of markets to even facilitate any small amount of non-US dollar transaction?
I do. I mean, it's your business, so you know the importance of liquidity at Keyrock, and you've been a day one partner for us in launching RLUSD. But one of the, for me, a bit of a surprise and really a cold start is pushing through and getting the exchanges and the market makers to believe in what we're doing and to provide the support, because nobody wants to fragment the liquidity that they have. Liquidity is paramount, and we'll talk about it later, I'm sure. As one of the key components of growing a stable coin, whether it's dollar or non-dollar backed. And so liquidity begets liquidity. And I think given the predominance of dollar liquidity in the stablecoin market, that's going to continue to be a key pillar of the overall TAM for the stablecoin industry.
Mm-hmm.
And
oh, sorry, go ahead, Amir.
Yeah, just to add on that, Jack, on the on-chain, section that we even looked at. So even when you look at on-chain, when we looked at dozens and dozens of these local currencies that are trading on-chain, 99% of the flows routed through the dollar, right? So even, and I think that's quite natural, right? I mean, that's what happens in traditional markets themselves, and even when you listen to, the industry leaders in this space, that they don't expect the dollar share to drop below 90%, right? Across local currencies, because that's how the traditional market, is still today. It's dollar led. So in many ways, that's even like, a macro question. But I do think like within the dollar stablecoins, you will see more diversification because, there's more companies, especially like, the more traditional companies that own distribution, that have like, millions and hundreds of millions of users that are trying to own their own economics. So I do think that will, diversify, but I completely agree, with Jack, that I think it's natural for the dollar to actually have a bigger share, and if it didn't, I think it'd actually be kind of boring for it not to have a 90% plus, share.
Mm-hmm. Mm-hmm. Okay. And yeah, it seems like if we move slightly away from the dollar stablecoin just for 1 second, it seems like more regions are entering the local stablecoin space. I think we've seen Brazilian real, euros especially, kind of entering this space with much deeper liquidity in the last few years. Where are you seeing the most of the activity on the demand or ramp side? I guess, Amir, we could start with you, but it'd be great to get Filippo's thoughts on it as well.
You're muted, Amir.
Sorry about that. I'm not sure how that happened. But yeah, a really interesting thing we saw. So, we pulled data from 30 plus centralized exchanges across all different jurisdictions from Latin America to Asia. And we really tried capturing we really tried capturing the global breadth of all these different exchanges based on their jurisdiction. So like the leading, Asian exchanges, the leading, Latin American exchanges. And one of the really interesting things we saw was that the Korean won is actually the third biggest on and off ramp when it comes to just volume between fiat and stable coins, right? And that sits behind, of course, the US dollar and the euro. We also saw that the Brazilian real was compounding at, a very nice pace. And I think, Filippo, this is, a lot of the work that you guys did, that you saw, how the Brazilian real has been, steadily growing over time. And, there's a few different, use cases there, especially given, the interest rates that you can get on Brazilian bonds, and how stable the Brazilian real has been against the US dollar over the last few years. And also payments, of course, with regulation and all the infrastructure, moving towards that. And I think one that is like, and in terms of ramping, that is still like super small, but we're seeing, some good momentum, is actually the UAE dirham. So, there's, I think, they're one of the larger remittance markets. And I think, and on and off ramp, like, you can really see that with the UAE. So, I think those are really like three interesting markets to look at.
Yeah, you kind of touched on the interest rates there. I'm just wondering what is the perfect setup for a non-US dollar currency to then transfer into becoming a stable coin? Because I mean, I would have expected the yen to be in conversation here, but obviously it has a different interest rate setup than other parts of the world. Is that kind of one of the primary factors, or is there anything else at play here?
Yeah, I mean, even on the yen, there's, yen stablecoins now that are popping up, and people are interested in the cash and carry trade with that. But with the Brazilian real, what I'll say is, I think, one, of course, like, the stablecoins themselves can grow. I think the Brazilian real is over 300 million. But I think there's also a lot of just fintech appetite in LATAM to be able to integrate, such things. Because on one side, of course, a lot of these users in these emerging markets want to hold the US dollars, but in terms of off-ramping, they still have bills to pay in local currencies, right? I mean, especially when we talk about the Brazilian bond market. So I think those are a couple reasons why the Brazilian real has seen interest and traction, and of course payments being having taken off in Latin America. Brazil has been like at the forefront of that, so that's been also good to see.
I'd throw one more in there, Ben, which is Japan. We've been watching Japan and have a longstanding presence in Japan. I think Japan's an example of a market that is obviously a strong financial center. There's been a loosening of the regulatory jurisdictional requirements there, I think in part due to what we've seen with the Genius Act. We just recently launched RLUSD through a distribution partnership with SBI, BC Trade, and I think it's a good example of entering into a market where you've got some regulatory clarity, you've got a local partner who can help you, not only with the licenses that you need to distribute it, but also they've got a strong hold in the market from a liquidity standpoint, which we were talking to Amir about, and also just having a strategic partner. And really, I think Japan represents one of those markets where you can think about stablecoins being complementary to bank deposits. Obviously, there's some extremely large Japanese banks, and the whole bank deposit or tokenized deposit movement is real and growing. Stablecoins, I do think, play a complementary role in terms of either having some interoperability between the banks and/or being a cash settlement leg in terms of what one might do with a tokenized bank deposit.
Okay, yeah, understood. I'm curious, just while you're saying that, how do you think, Jack, about the cultural differences across the world in terms of stablecoins? And the reason I bring this up is I was listening to Dylan and Claire of MetaPlanet talking about certain functions within Japan and saying it's very old school. They had to literally send sort of dividend payments through the post. And I think about the cultural differences between Japan and the US, where maybe they're much more sort of familiar with the Robin Hood style distribution of stable coins. Is that something that you guys have thought a lot about at Ripple?
I think it's an excellent question, and it's a very important consideration when you enter into new markets. We're blessed with over 15 offices around the world. I think we're up to 85 licenses. So in most of the large money centers, we have a local present, boots on the ground. We have licenses to be in the flow of funds. Where we don't, and Japan's a example, we cover them out of our Singapore office. Where we don't have boots on the ground, I think we prioritized finding strong partnerships. We certainly have that in the payments business. That was really our origin story. But when it comes to stablecoins, I've learned a lot through this experience working, particularly with local counsel. The regulators drive a lot of the process when you're entering into a regulated stablecoin market, and we have invested a lot of time and resources and subject matter expertise with our regulators here in the U.S. and in more recently in Europe. Not having that history or that experience in Japan really encouraged us to rely heavily on local counsel. We do have some experts in our Singapore office who covered Japan, and so they were influential. But other partners that are required to bring something like this to bear is really critical. And I think it just reiterates the importance, as I mentioned earlier, of having a local partner on the ground. In our case, SBI, who's long been a partner across the board for Ripple, was critical in terms of our being able to open up that market. It would be very it would be very difficult to do it without a local partner.
Mm-hmm. Yeah, okay. Understood. Thank you for that. Filippo, I'm conscious that I'd like to bring in you and really highlight Dune data. So I was looking through the work that Dune did earlier, particularly on EURC, the Circle's European stablecoin, and it looks like EURC behaves quite differently from other local stablecoins. It has much more DeFi integrations and more financial asset usage, especially on chain, whereas most non-US dollar stablecoins actually just look more like payments, and perhaps some treasury thrown in there as well. Why do you think that EURC looks so different? And is it a useful way to think about the rest of the category, in that perhaps they also could follow the same path?
Yeah. So basically, first of all, EURC is one of the biggest in terms of supply, in terms of transfer volume. Basically, across all the metrics, is one of the probably the largest by far individual token. And then euro-pegged stablecoins are the largest category of non-USD stablecoins. And as you said, EURC is a little bit different because, again, when we use our tags and categories to qualify both where the stablecoin sits and also from where and to where it transfers to, like it transfers, you can see EURC is moving and behaving a lot more like USD pegged stablecoin. So there is a very heavy DeFi footprint, especially for liquidity provision and DEX activities. Then if you go even deeper, then you can pinpoint these activities mostly focus on Base blockchain and Aerodrome as a DEX venue. So there happens to be a lot of arbitrage bot activity on Aerodrome on Base for EURC, which is super interesting. And this doesn't definitely happen with other non-dollar stablecoins. They have very limited DeFi usage. There is a little bit of decentralized exchange volume, but it's not major. Very, very far from the Circle Euro stablecoin. And another venue where you see Circle Euro a lot is lending. So it's accepted as collateral for major lending protocols like Morph, Aave, Camino, and others. And very few other stablecoins can say that, like non-USD stablecoins can say the same. So I think obviously DeFi is permissionless, so anyone can do anything with these tokens. But eventually, you still need some kind of partnerships to, embed or accept a certain token as collateral for lending, for example. And that's where utility starts growing for a certain stablecoin. So I think it's a kind of positive flywheel that we see, and that also is about liquidity. So I don't think liquidity is I don't think everything starts with liquidity. So I don't think the growth of a token is, blocked by the lack of liquidity. I think liquidity will come once utility is there. So if you have a lot of DeFi use cases, if you have a lot of partnership with local fintechs, banks, businesses that accept that token for payments and transfers, then suddenly there is a need or a use case for that token, and I think market makers and liquidity will be there, to support this token. I think that's what happened with Circle Euro. Obviously, Circle is a powerhouse, so it's probably easier to get this flywheel started. But I think a lot of other non-USD stablecoin can do the same, and BRLA, so Avenia, BRL, Real, Brazilian Real, is kind of on a similar path. So they have excellent connections and partnerships with local payment fintechs, payment app, card programs, the local government as well. And they are seeing a very meaningful growth, both in supply and transfer volume, but especially in payments. Again, we have a payment data set, so we specifically segment payment like commerce, card payments, agentic payment, and we separate these from the rest of transfers. And we see Avenia's Brazilian Real stablecoin is doing about 40 million a month in payment, and that's the highest across all the stablecoins that we're tracking, even more than Circle Euro. Obviously, we are not able to track all the card programs, all the commerce using these stablecoins. So that's obviously a subset, but in this subset, BRLA is definitely the fastest growing, and it's also being more accepted in DeFi as collateral. So I think Circle Euro is definitely an exception, but it can also be considered as like a sample path that other tokens can follow.
Okay, yeah, fascinating. I'd like to think that we're hopefully contributing to the liquidity on that asset. One thing you touched on is the lending market for USD. It seems like quite a lot of utility is downstream of that. Do you have the numbers on just how deep that is, the lending market?
Unfortunately, I don't have the numbers right now. I can follow up with that. Yeah, I don't have it right now. Yeah.
What I will say too on that point, on the lending markets, when I forget exactly the time period, but around 7-8 months ago, when the dollar started using some of its purchasing power while the euro, was gaining against it, actually we saw that uptick in the Aave, lending markets, right, with euros, right? So I think, when it comes to trading, I mean, of course, even with the MiCA approval that we see across exchanges with USDT being delisted, the money flows more into the next compliant USD stablecoin, right? But where you provide a use for the user to retain and save some of their purchasing power, that's when there's maybe a need right now for euros. And when we look at these on-chain pools, like we also saw that the euro is the deepest, but relative to where the let's say the FX market is, I mean it's basically negligible, right? It's more of again, it goes back to that order of traditional FX markets. It starts with US dollar, it goes euro next, and then maybe like Jack mentioned the yen and so forth. So I do think that's interesting that when it comes to purchasing power, these lending markets are being used more and more to preserve these types of so yeah, I think Filippo, you're right, and I think if these products are also built in fintech type products rather than on chain, I think you make that friction a lot easier, which is I think what Aave is actually building, right? They're building a financial app.
Yeah.
So that users don't have to, go through all the hoops because, my for example, would have no idea how to bring the money on Aave.
Exactly. And I think in terms of speaking of utility, we tend to see, or we tend to categorize like payments and DeFi as two kind of separate tracks that gives a stablecoin utility. But we are also seeing the beginning of kind of convergence between the two. So again, for Brazil, BRLA is being used a lot for payments, like local payments. But then because people hold this token in their wallet or card balance, there is now the possibility to invest to kind of earn additional yield or passive yield by lending the balance on the background on Morpho. So this idea of like the DeFi mullet, where you have a non-DeFi or non-crypto native front end where people park their money or use the money for payments, and then at the same time integrations or on the background with DeFi protocols like Morpho, then suddenly you have okay, you can use both the stablecoin for payment and for generating yield on DeFi. So the two things are not separate anymore.
Mm-hmm. Yeah, it's very good to see. It's kind of like the market maturing slightly. On that point, Amir, I've got some notes here from the report, and one of the really interesting points that you made is that there's a very distinct difference between how stablecoins are used and how currencies are used in traditional markets. I've got here that currencies in traditional markets are used in swaps and futures twice as much, or around twice as much as they are in spot. But on chain, it's traditionally almost pure spot at the moment. And it seems like that comes from the lack of lending market. But as Filippo just spoke about, those could be deepening for a few different reasons. Would you be able to kind of expand on that point and tell the viewers about that dynamic and where you see it going?
Yeah, frankly, I think frankly, the products on chain for local, stablecoins, I think there's a reason why they're not, being built, right? Because everything is in US dollars, right? So, you're in a way actually bringing friction to users by bringing it on chain and allowing it for it to trade on chain. But I think where the most interesting thing is in terms of the actual good use of local stablecoins is bringing it into these local payment companies and fintechs in those specific jurisdictions that are holding both Brazilian real and they're holding, let's say, the US dollar, right? And the end user would not need to know whether they're using stablecoins or not, but in that sense they're actually meeting users where they are, right? I think a lot of this story is with local stablecoins is building things where the users are not, and it's very hard to get to those users, right? So yeah, I mean, I think that's the dynamic that we're seeing on chain is, a lot of this will first have to be built in the traditional world, and I frankly think it's more of like the rails rather than the specific type of stablecoin, right? It's all about the rails and like routing through the correspondent banking network, and frankly, a lot of it is can be done through fiat, right? The on and off ramps and the routing. It's with local stablecoins, there's some niche use cases when it comes to settlement, but those are present in emerging markets and typically not in the in the G10 countries, because those rails are pretty well developed and you can send money pretty fast at very low fees.
I would just add, I agree with Amir's comments there. I would also suggest, in thinking back on what everyone was saying, earlier, if you think about the kind of core principles of programmable money, there are certain attributes that are just better, right? It's 24/7, it's faster, it's cheaper. But to Amir's point, you have to find real utility in those, and in efficient markets, like let's just say the U.S. and intraday payments, fiat works pretty well. The system, I wouldn't say is broken. But in our, just sticking to the U.S. market for Ripple, two use cases where I think stablecoins represent an improvement on what's hitherto been an efficient ecosystem is in the corporate treasury market, where we have a lot of our corporate treasury customers that we acquired through the acquisition of G Treasury, now called Ripple Treasury. And you can think of 1,200 corporate CFOs and treasurers who essentially make payments, all day. And even domestic payments, when you think of stablecoins, initially you think about, the stablecoin sandwich, cross-border, that's where the efficiency is. But instant settlement with a stablecoin brings that whole experience better. And if you can think about untrapping capital that gets locked on nights and weekends and starting to use a 24/7 dollar equivalent, all of a sudden that domestic corporate treasurer has more efficiencies, some enhanced yield opportunities, and less friction, where it makes their job better and it improves the economics for them. And having the regulatory guidance from clarity, and having infrastructure providers like banks, and we work a lot with BNY and other large GSIB banks, all of a sudden you're able to deliver an improved upon experience when no one was really standing up, pounding the table, saying the current experience is broken. Another one is in capital markets. We have a front row seat there, again, through the acquisition we made of a company called Hidden Road, now Ripple Prime, where the U.S. equity and derivative markets work pretty efficiently during the day. And yet when you can think about using a stable coin, for example, as a cross-asset class margining tool and post that as collateral at exchanges to get the same treatment that you would get as a treasury or money market fund or cash, it extends the purchasing power of what you can do, and also adds more flexibility on a 24/7 basis to investors who want to trade globally and move in and out of different asset classes, but doing so with a stable coin. So those are just two examples, I think, where, as the regulation continues to warm and the infrastructure, whether it's custody or accounting or reporting, data, folks at Dune do a great job, I think, of helping institutional customers get more comfortable with the way they're doing business, I think there's some big unlocks that we're just starting to see come into the marketplace that have a lot of future benefits to come.
Mm-hmm.
And
No,
just,
that's cool.
and just sorry, just one last thing that I'd like to add to that. So, when we speak about settlement times, sure, it does improve it, but I think a big advantage for, the companies integrating local stablecoins, USD stablecoins, is actually like the pull into the back office. A lot of these fintechs, they spend, a lot of money by reconciliation. They do manual ledgers, by hand. They square pulled accounts together. And even, for example, if you're not even speeding up settlement time, this lowers your operating costs by quite a bit, right? Because the rail itself is a ledger. So I think that's also another key to to stablecoins, especially where they're finding product market fit, is that regardless of settlement time, they're also helping back offices quite a bit.
Yeah, no, that's very, very helpful for everyone, just to paint some pictures of the actual customers who are using this kind of product. And the fact that, I mean, we haven't really touched too much on FX price on chain, but there's other kind of benefits there aside from that. You also touched on the Clarity Act. We've had some developments in that in the last week or two. I kind of want to throw that out to the floor. If anybody wants to make any comments on it, it'd be great to get some discussion going there.
Well, I mean, it's been a bellwether piece of legislation for the industry writ large, and not to mention, obviously, the stablecoin industry, but I think more broadly, digital assets. I think if I could be as objective as possible, that stablecoins are probably the most unanimously thought of real world use case for digital assets, particularly for the skeptics. They can get their head around a stablecoin given how they operate. And for the US to codify that into law, I think is a major advancement. And I was touching upon earlier some of the non-US markets where we operate in, and I can tell you just from my own personal travels, that is a shot across the bow globally, and you're seeing other jurisdictions take note of that and really use it as encouragement to liberate their own markets with pro-digital asset legislation. So I can't underscore enough how important that is. Clarity is obviously the companion to that around market structure. And I'm an eternal optimist, so I'm still lighting candles and crossing my fingers and toes. But, I think particularly for the US, who was, arguably lagging behind, this was a huge step for not only the US, but as I mentioned, the overall market. And so I can see that the flow through to other participants in the ecosystem. It's liberated a lot of the buy side who are now more comfortable entering into the space using a stablecoin as a companion to their, tokenized money market fund or RWA. You can see it with the service providers, the traditional banks, custodians, audit firms, fund administrators, lawyers. It's really been a kind of an all clear signal that big major institutions can enter the space, and the corporate customers that we deal with who have never touched crypto before. This is a first entree into getting the benefits of the digital asset and distributed ledger technology without having to, dive deeply into what they, otherwise thought of as crypto. So I think it's been extremely important.
Yeah, I definitely agree with Jack. Like, this is also one of the theme of our report, and I think of yours as well, guys. The fact that regulation has become a tailwind for stablecoins in general, but also specifically for local stablecoins. I think Euro, Brazil, Japan, they all benefited a lot from having early, clear, and obviously propositive and favorable framework to develop. And I think it's interesting also, one of the dynamics that we see in place, which is local governments have interest in developing stablecoins, specifically local stablecoins that invest in local currency, like purchase local currency and bonds, right? So we see most of the regulations, frameworks requiring local, stablecoins used in each country to be backed by maybe 90% of reserved by like local currency or bonds. Japan is one of these examples, and so there is obviously a lot of like you can see a flywheel between the development and expansion of a stablecoin and the demand of for local currency and bonds. So I think this is a powerful dynamic that can definitely encourage a lot of countries with such regulation to develop their own local stablecoins as well, on top of USD ones.
Mm-hmm. Yeah, that's a fantastic point about the kind of sink for domestic bonds, government issued bonds. How much, I'm curious, Amir, Jack, whoever wants to jump in here, how much do you think the transparency behind the collateral of a dollar stable coin is important, to the extent that we've seen, I think recently, Amir, Circle and Tether pushing into other forms of collateral behind their dollar stable coin? Obviously, two questions baked into one. Transparency, I think, is paramount. Do you have any pushback on that? And two, the actual backing, how much do you think simplicity versus maybe more of a diversification strategy makes sense?
I think it's paramount. It depends on what your target market is. I can speak just to our own target market. We are betting that the 0 to 250 billion, which has largely been driven by retail customers in emerging markets. We think the 10x from here is going to be more institutionally driven. And if you're talking about the G10 markets and targeting institutions, they care about regulatory scrutiny. They care about licenses, and embedded in that, certainly in the US with the Genius Act, is a very strict governance in terms of what high quality liquid assets you can invest in and the transparency and reporting around those. So I cannot envision going after the target market that we are without being very specific and transparent about what the backing assets are and the liquidity of them. So it's not enough to just say we've got cash and cash equivalents, treasuries, money market funds, reverse repo, but it's how liquid is a portfolio. I get asked quite often about stress scenarios, how quickly redemptions could occur, and in our case, we over collateralize our reserves deliberately and voluntarily just to help ease the demand side of the equation and gain comfort with our customers that they're going to be able to redeem their stablecoin when they want to. And you have to be able to back that up with the assets that you're investing your reserves in, and who the custodians are and how liquid that basket is.
Yeah, I mean, the stablecoin business was built, first most off of trust, right? That if I put my money in here, I can redeem it, 1-to-1. And I think, of course, when you look at CFOs and when you look at the US in specific, especially as you get, regulation, you have to touch, stable coins that are actually very, let's say compliant. And I think that's where you see the tether split, I guess, with, the rest of the market. Maybe they don't want to be, in certain markets, or they see their advantages in different types of markets. But I think that trust is paramount to onboarding more users, and you have to really back it with in a way that tokenized treasury, the only counterparty you have is the US government, right? So you're not taking on too much more risk. But if you start diversifying and investing in other things, sure, it can work as a strategy, and those different things that you have invested the share of dollars in could be low risk. But you start acting like actually a trading firm or an investment firm when you start doing that. And when you look at the CFOs especially in the US market, they would like to touch something less risky, especially when they're coming into crypto already, let's say maybe with a skeptical view, right, of how things work. So even if the diversified backing is, and that's why I think also we'll see a big diversity of these stable coins, right? People want their own economics, when it comes to issuance of stable coins. But yeah, I think the safest model in the end will win, and I think it'll be based off of the distribution that it gets, right? And I think when the reason it'll get that distribution is because it's so safe, right? And because of its compliance.
Okay, very good. I'm conscious of time here, so I think we've quickly mixed it up to look at centralized exchanges versus on-chain. So, I mean, Amir, I think you'll probably be best positioned to answer this. Centralized exchanges still account for the vast majority of stablecoin FX transactions per data, and I think per Dune's as well for Lipo. Do you expect that to shift meaningfully over the next 12, 18 months, or is on-chain FX still a bit too early from
I certainly think like centralized exchanges, they've been growing quite a bit. I mean, even in the downturn that we've seen, if you actually look at on and off ramps on centralized exchanges and fiat to stablecoin trading, it's actually held up quite well, right? What you mentioned at the beginning of the call, that the breadth has gone from 10 currencies to 19, and then you're seeing different pockets of the market, different regions of the market, on ramp, different types of fiat, and those are growing. And we see that with Asia, we see that with like Brazil, we see that a lot across Latin America. You're starting to see it in these other smaller markets that are getting some more regulatory clarity. And there's a couple of things here. So one thing is that when we looked at all of the liquidity pools, we tried our best to get all the liquidity pools that hold these non-local USD stablecoins, and you see that the full liquidity across all these pools is 46 million, and I believe only a very small percentage actually trades inside a 2% slippage band, right? And that is quite different than normal FX, where your pricing actually improves as you increase your size, right? On-chain, I mean, mechanically with AMMs, you get slippage the more you increase your size. So I think centralized exchanges will, win this battle, at least, for as far as I can see in the next few years. And they are becoming very rich and deep venues for being able to do such transactions, more than they were 3, 4, 5 years ago. And I think, if they're able to keep adding depth and liquidity, I think, you don't have that pricing liquidity problem where, as you're increasing the size, you're having more slippage, right? And I think, given the fact that, you have to KYC to be on a centralized exchange is also a massive benefit, right? I think there's a reason also why we don't see those, the depth in those pools is because a lot of the payment firms maybe do not want to route through those pools because it's a compliant mess of who else has their money in a certain type of pool, right? And I think where we saw the biggest traction from the on-chain part was actually the sanctioned Russian ruble, right? And I think that's where you actually see hey, on-chain, this thing is getting a lot of usage because it's not regulated properly. So I definitely think centralized exchanges win this over the next few years.
Yeah, I agree with Amir. Just to give a few numbers, I saw that in June, non-USD decentralized exchange trade volume was only 750 million, which is tiny compared to centralized exchanges or even decentralized exchange for USD stablecoins. 90% of that is Circle Euro, and basically 99% of those 750 million is a non-USD stablecoin pair with a USD stablecoin. So it's basically like a dollar hub and spoke model rather than a lot of non-USD versus non-USD pairs. That's what it is on decentralized exchanges. The liquidity is very thin, as Amir mentioned, so slippage is bad. And as I mentioned before, even centralized exchanges are now embedding a lot of DeFi solutions on the background. So there is probably less need to just live purely in a decentralized self-custodial world. I think the centralized exchanges are getting really good at this. And even traditional fintechs are becoming better and better crypto products. So I think it's probably unlikely that non-USD stablecoins will mostly be on decentralized exchanges in the future. I don't think this is going to move anytime soon.
Okay, very interesting. one last question before I put a general question, forward-looking one to you. Jack, in practice, we've obviously heard a few different differences between on-chain FX and traditional FX. But if we look specifically at local stablecoins, where do you see them winning against traditional cross-border FX flows? Obviously, liquidity is not there at the moment. Is there anywhere else that they could potentially win?
Well, I think just in general for cross-border payments, senders and receivers are going to look for the most efficient way to exchange value, and where that value can be exchanged online, the Internet of Value, which we continue to kind of have as our mission statement. I think you will see traction grow there. I keep going back to what those pillars of adoption are going to be, which has to do in no particular order with regulatory clarity, with liquidity, as we've been talking about, and with the operational readiness that ecosystem is going to require. And when you can make it easy for people to take advantage of a digital asset that is in the flow, the stablecoin sandwich, I think you will see consistent demand doing it. Again, we're experimenting in the early days right now with these corporate customers of ours that have not used stablecoins or any digital asset in their flow, and getting them comfortable with how it operates. And even when you abstract away much of the nuance, there's keen interest in doing it when you can educate them about how it works, the different aspects of the offering, again, given a regulated entity like we have, and how we operate and what the backing is and where the liquidity is, and seeing is believing, I think. And so I do think that there's a evolving and growing use case that you'll see in the payments business, and you will see that bleed over to some of the exchanges and the trading pairs, where let's just take, if the European Central Bank ultimately does issue a wholesale euro, which they've been talking about, a CBDC. There's also initiatives around a retail euro, but ultimately that will be a very efficient use of a digital asset within that walled garden. But when there needs to be an on or an off ramp, you will see these trading pairs grow, and most likely it's going to be a US dollar pair that would exist, that would trade either with the market makers or on the centralized exchanges. So I think you're going to see a parallel path of growth, and the TAM will increase as a result.
Okay. Thank you very much for that, Jack. Look, we've only got a few minutes left, so why don't we wrap this up with a forward-looking question for all three of you. Filippo, perhaps we'll start with you. Which market or corridor are you most deeply watching over the next 12 months, and why?
Yeah, as probably you guys guess, is Brazil. I think Brazil is interesting because first, it has the highest number of distinct local stablecoins minted. Issued. So I think it's about 7 right now, and it's just below the euro. So I think obviously maybe more than half of these will fail. Probably 1 or 2 will just become big enough to kind of compete with the dollars within Brazil, at least. But this experimentation, I think, is very interesting and very bullish for Brazil as a system, as a financial system. There is a lot of excitement, a lot of experimentations, and partnerships are already there with apps that people use every day to pay and transfer value. So I think definitely Brazil is one of the most interesting. I would say also it's interesting to see how different regions process the payments, and I think this also informs how strategies and how local stablecoins develop. For example, Latin America is very much card payment led, the same as Europe. There is a lot of using the phone to pay with a virtual card, and then you have Asia, which is mostly apps and QR codes. So I think also following these different mechanics of how payments are processed, it kind of influences how local stablecoins develop. And I'm thinking about Japan, for example, who's moving directly from basically using cash to using stablecoins without going through much of cards, digital payments in a traditional way. So yeah, my answer would be Brazil anyway.
Very good. Jack, you've given us some great insights on the call, but is there anything in particular that you reckon the viewers should watch over the next year?
I would definitely double tap on Brazil. We've got a big presence there and quite active. Two markets that haven't been mentioned, Turkey and Korea, are important to us. In both instances, you've got regulation easing and becoming more accommodative. You've got local exchanges there becoming an on-ramp, so not just a listing venue, but actually getting into the flow. In Turkey, we recently launched RLUSD through partnerships with Bitlo and Bilira and others. In Korea, I think we're now on 3 of the top 4 exchanges there, just announced yesterday, Upbit begin trading. So we've got, again, local partners there on the centralized side who will bring the liquidity, and we're quite optimistic and bullish on the markets there.
Yeah, and I have to go Korea as well. I mean, when I was doing the data pooling and seeing how how big the ramp in Korean exchanges has grown, it's quite remarkable because you're not seeing any type of on-chain stablecoin presence for the Korean won. And there's some regulatory things that that's being fought over, whether who can actually issue a Korean won, whether it's the central bank's authority or whether fintechs can do it as well. And I think going into 2027, there will be some laws that will be enacted that give it that clarity. So I think that's definitely an interesting, one to watch, especially, as we saw, we worked with Mirai Asset Management. They were very, very excited to be working and learning more about stablecoins and launching their own RWA space. So even as a cash leg to tokenize money market funds for the Korean won, I think that's also a very interesting thing to look at. But of course, I think markets closest to America in terms of payments will also benefit greatly, right? Because you have different jurisdictions at different stages of their knowledge and of in terms of their law of enacting of how they want stablecoins to play out. And I think America is right now is furthest ahead, right, in that. So whoever their counterparty is, which typically is the Central American or Latin American countries, I think those will benefit off of the crux of that of that legislation.
Okay, fantastic. Look, I think that's a good place to stop. Jack, Filippo, Amir, thank you very much. That was very insightful. For anybody listening, the report that Amir and the partners put out is how local stablecoins trade from exchange to on-chain. You can find that on Keyrock's website. It's free to read and download, and obviously we're very grateful to our partners, Bitso, who we published it with. So again, Jack, Filippo, Amir, thank you. And thank you to everyone who joined us today. Enjoy the rest of your day.
Thank you, guys.
Thank you, guys. Thank you, Ben.